Welcome to this video. In this video, we want to demonstrate how to estimate the value at risk of investing in security. So in this case, we're going to be estimating the value at risk for investing in some tech stocks such as Apple. So what is the value at risk? Value at risk is basically the risk that is taken to invest in a certain security. So say you want to hold a stock for 1 month and you want to know the risks that you are exposed to holding the stock for a month. That is the value at risk of holding a particular security for a month. So the 95% confidence with the value is the 5% chance that you might lose that amount of money. So the value at risk at a certain confidence interval is the percent, 100%, and then you deduct whatever the confidence interval is to get the chance of you losing that amount of money. And this also helps you to get exposed to diversifying your portfolio as a result of knowing that you are exposed to a certain kind of risk. So basically, that's what the value of risk is. And in this model, we're going to be demonstrating this in Python. So we're going to be talking about a lot of things here. So first of all, we're going to pull data from Yahoo Finance, and then later on, we will use the Monte Carlo simulations to predict what the risk is going to be if you hold a security for 1 month today. So we're going to predict what would be your loss of holding a security like Apple for a month. So that's what we're going to be doing in this model. So hopefully you're going to understand why certain strategies are being taken at certain points in time where you want to be exposed to other investments as a result, taking arbitrage opportunities in other markets. You might want to diversify the portfolio of your clients as a result of knowing the value at risk. You might also want to change your strategy as a portfolio manager or a fund manager, such as maybe taking a short position or going long. You might want at the same time maybe introduce another strategy into your mandate as a result of this kind of risk analysis in your model. So having this set down, then you can be able to achieve your goal or your investment mandate. So evaluate risk of investing in security is very, very important in risk management. So capital preservation might be another strategy you might want to take as a result of knowing the risks of investing in a particular security. You might want to change the strategy to maybe an income strategy, invest in securities that pay dividends as such, or you might want to embark on capital gain securities and start taking those kind of strategies just because you were engaged at a certain point in time in understanding the risks at investing or whatever amount of money you might lose at a certain time. So you might want to change the strategy as a result of that. So that is why we call this the value at risk of investing in a particular asset. So in this case, we're going to be using the parametric approach to value at risk. And we're going to be demonstrating this digitally in Python. First of all, we're going to pull data from Yahoo Finance, and then we will later on calculate the value of the security at a point in time, and then we will later on introduce certain matrices that will drive our model going forward. So that's exactly what we're going to be doing here. So it's very, very important for us to model value at risk at any one point in time in our business, because knowing the risks of your business might enable you to take upon certain decisions that might impact the profitability of. So now we're gonna be modeling the value at risk of investing in Apple stocks. So as we said, Apple is a tech company and it is exposed to a lot of risks than any other industry because it's a technologically based stock and it trades on the Nasdaq. So we're gonna be modeling the value at risk of holding Apple stocks for 1 month. So that's exactly what we're gonna be doing in this model in Python. So the first thing we wanna do is to import some packages. So we're gonna import numpy as np, import pandas as pd, import matplotlib, .pyplot as plt, import Y finance as YF. And then here we want a package that contains all kind of statistics and distribution functions. So from skypy.stats, we want to import none. And then what next we want to do is to make every code block appear, every chart appear under every code block. So we're gonna go by %map.lib inline to bring every chart under each code block. So we can now go to the next, and then what we want to do now is to assign the ticker that Apple trades with on the Nasdaq. So to assign the ticker, we're gonna type ticker just like this equal to, and then we go AAPR. That's the ticker Apple trades with on the Nasdaq. And then now we want to pull the price from Y Finance. So in order to do that from Yahoo Finance, we gonna assign the price to be equal to YF, which stands for Y Finance dot ticker. In this case, we want to assign the ticker to be capitalized because Python is very case sensitive, so we want to make sure that we are going according to how this code can be written on Python. So having assigned that, the next thing we want to do is to pull up the data from Yahoo Finance. So we're gonna go by, since we already defined the price, so we're just gonna say price dot history, because we already defined the price to be yfinance.ticker in bracket AAPL. Now we can go price.history, open and close bracket, hit shift and enter, and as you can see, we have the open, high, low, close, volume, dividends, and stop plates. So as you can see, this is exactly what you're looking for. But then what we want under this data is to extract the last price. So we're gonna go to the last price. So as you can see, 2024, and the date of today is the 10th of September. We see that the last price or the closing price is at approximately $220 per share. So we want to extract that price. So that's exactly what we're trying to do in this code. So in order to do that, we have to rewrite the code again by assigning .tail. We want it to be 1, and then we open the brackets. We want to assign the column. In this case, it's going to be the close. So we make sure that it's exactly as it is written there. So we have to capitalize the C, the close, and then dot ilog0. Ilog is just to capture or to lock the price. So we are just using the ilog0 in brackets like this to capture the last price, and then we can now hit enter just like that. As you can see, the stock price is currently trading at approximately $219 per share. So that's exactly what we are doing here. So the next thing we want to do is we want to draw samples from the So now we are ready to draw samples from a standard normal distribution to demonstrate the Monte Carlo simulations in this model. So in this case, first of all, what we want to do is to draw 5,000 samples just to demonstrate how these samples can be distributed using a normal distribution. And then we will later on use the Monte Carlo simulations using this amount of samples or even more to determine the value at risk of investing in Apple stocks. It's exactly what we're trying to do here. So the first thing we're going to do is to assign the simulations to be equal to 5,000, like that. Then we are going to go by sample equal to, in this case, numpy.random standard normal. So we're drawing samples from the standard normal distribution. And then we assign our simulations, which is 5,000 in this case. So that's exactly what we're trying to do here. So now we can go by to plot a histogram. So we can now go by plt.hist to demonstrate this in a histogram. And then we want to demonstrate the sample, and we want the bins, in this case, to be equal to 50. And then we can hit a semicolon. This is just to demonstrate this distribution of 5,000 samples. As you can see, we have those distributions are normally distributed. So in order to estimate the mean, we will just go by mean equal to, so we are asking what is the mean. So in this case, the mean is going to be equal to numpy. We use the numpy dot mean in bracket sample, and then the standard deviation, we'll just call it STD. So in this case, it's going to be numpy dot STD sample. And then the next thing we want to do is just to print it. Print mean, print STD. So as you can see, this distribution have a mean of approximately 0 and a standard deviation of 1. So we're going to be using this distribution, this standard normal distribution, to simulate going forth the value at risk of investing in this Apple securities. So this is actually the Monte Carlo simulations, where we have so many simulations so that we can come up with the approximate value of our value at risk at a particular time. So that's exactly what we are doing here. That's exactly what we are doing here. So next, we will demonstrate or we will calculate the value of Apple. So we will just go by so now we will go by assigning the number of shares. So shares AAPL, this is how many shares we are buying for a month. So in this case, we will just say we are buying 1,000 shares from Apple. And then to calculate the value of those shares, the value of AAPL is going to be based on the shares times the price. But in this case, we don't yet have we haven't yet assigned this last price, or we haven't yet defined the last price. So we have to redefine it using, we will just go price underscore APL. We'll just redefine it like that, and then we can copy the price, copy, and then we can now paste it here as the price. So then we can now run the code block again just to make this pull up in our next coding. So it's gonna be this price times the outstanding number of shares we are buying at this point in time. So we are buying 1,000 shares. So now, in order to determine the value of this Apple stock, we're gonna go by value underscore APL. It's gonna be equal to shares of Apple, and we multiply that by the price. So we want to calculate the market value at this point in time. So we're gonna print that, just market value APL. And as you can see, we can calculate it as it gives us approximately $219,000, which you can see approximately $200,000. So that's the amount we're gonna be buying these stocks at and holding it for 1 month. So we want to calculate the risk of how much we will lose as a result of holding this security for a month. So we're gonna be using the Monte Carlo simulations, as we said, in calculating the value at risk. So now we want to determine the value at risk of holding the stock for 1 month. So the next thing we're gonna do here is we want to go by estimating. We already drew samples from a standard number distribution, so we're gonna define the simulations again to be its time to be equal to 50,000. And then what we want to do next is to the time period. So T underscore AAPL, that's the time period we're going to be holding this stock for. It's going to be equal to 21 trading days divided by 252 trading days. So basically the stock market trades approximately 21 days in a month and 252 days in a year. So that's why we are taking the average. And then the next thing we want to define here is the volatility of the security. The volatility of the security is just the difference between the movement in the returns of Apple stock. So since it's a volatile stock and we know that it's a tech company, we know that the securities or the stocks are, or the returns of the security are not constant. So they change every day because of that volatility of the security. So in this case, we will extract the volatility of Apple stock from an equity research analyst team. So in this case, we will say the volatility is approximately 0.214. That's the volatility of Apple stock. And then the next thing we want to assign is the risk-free rate. The risk-free rate is just the rate at which this particular stock or this particular security is operating at in that industry. So if we say, in this case, the risk-free rate of Apple as given to us by our research analyst team, you can find that on Yahoo Finance. Still, it's going to be 0.0216. So the risk-free rate in the United States is just a long-term bond or a treasury bill. That is the risk at which you might buy securities or hold securities from a government bond. So we also have the risk-free rate or the industry risk as a result. So in this case, we will assign that to be 0.0216. And then the other thing we might want to assign here, after accounting for the volatility and the time and the risk-free rate and the simulations, the only thing we might want to assign next is so we might just want to redefine the value at risk here, the formula. So in this case, we will just go to the next code block and we will define the value at risk using lowercase. So define the value at risk. So now we're going to redefine our value risk. So the value risk for holding the security for 20 days. As we know, we already defined our time volatility and the risk-free rate above, and we have our number of simulations the same around to be equal to 50,000. So we're going to define value at risk to be def, and then we go value at risk like that. And then we're going to take into account, first of all, the present value, which is the value of the security from the time of the market close. So we take the value of the security of Apple from the time of the market close, and then we take into account the risk-free rate, and then we take into account the volatility of the stock, and then we take into account the time which we're going to be holding the security for, and we take into account the number of simulations we're going to be simulating using the Monte Carlo simulations. So we take all of those variables there, and then we go by semicolon because we are already defining this formula. But the first thing we have to do is to make sure that we have every variable linked to the value of the security or linked to the security. So in this case, the volatility, we're going to assign it to be AAPL to be equal to that variable. So we're making sure of that, and then we can now run that setup. And now we can continue to define the value at risk here. So in this case, it's going to be equal to the end value, and then we deduct the present value from the end value. So that's exactly what it is. So we're going to calculate the end value because we already know what the present value of the stock is. So the value of the stock today at the time of the market close is roughly $219 per share. But we don't know what the end value is, so we have to calculate the end value. So in this case, we're going to simulate using this formula, end value. This time around is going to be equal to, we're going to take the present value into consideration, and we'll multiply it by numpy.exponential function because it is linked to a kind of a formula. So we take the numpy, we refer that formula to numpy. So it's going to be numpy.exponential. What we want to do in this case is we want to take the risk-free rate, and then we deduct from the risk-free rate half of the volatility of the stock. We write it like that, and then we want to square the volatility. So have the volatility of the stock squared. That's it. And then the next thing we're gonna do is to multiply it by the time we're gonna be holding the security for. That is 21 trading days in this case. And then we now want to go by, we want to simulate this using the Monte Carlo simulation. So we go by numpy.random dot standard normal, and we want to run 50,000 simulations in this case. So we already defined our simulations to be 50,000. So we have it there in place. And then we want to go to the next line. If you might still want to continue, but to make it clean, we just want to go to the next line. So we hit enter, and then we want to multiply the simulations by the volatility, and also we want to multiply that by the square root of. So we go, since it's a formula, we go by numpy.square root, like that, the square root of the time t. That's exactly what we're seeing in this formula. So the only thing we want to do here is to close the brackets to make sure that we can close the, so we're gonna wrap this in another bracket. So now we can now close this as such, and that's it. We're good to go. So now we can now hit enter, and now the next thing we want to do is to come up with a formula that says that the returns in this case is going to be equal to the end value, and we deduct the present value from the end value. That's it there. So what next we want to do is to simulate the returns. So we'll go returns, and now we are ready to now calculate the value at risk. So we will now go saying the returns of Apple, returns of AAPL is going to be equal to the same formula, the value at risk, which in this case we will now use our variables we actually defined above. So in this case it's going to be having simulated that formula. In this case, the next thing I want to do is to calculate the value at risk. So in this case, we just going to calculate the returns of the security. The value at risk of these returns is going to be equal to, we have the we define it like that, but this time around we have to take into considerations the variables we define for Apple above, like this, the particular security above. So in this case, we know that we had the present value, which we define as value APL, and we also had the risk-free rate, which we defined as the risk-free rate AAPL. We also had the volatility of the stock, we defined as vol AAPL. We also had the time, which we're going to be holding the security for, which we had as TAAPL, and we also had the simulations. So we have it well defined there. So now we can just print this out, returns AAPL, and we'll see what the values will be. As you can see, we have the array of 50,000 different simulations calculated for us. So the risk of holding the security for 1 month is within this array. So in order to calculate the confidence interval, the 95% confidence interval, the 99 and the 90%, we have to use certain functions in Python. So in this case, we're gonna define our percentiles. So we're gonna say percentiles to be equal to we begin by 90%, and we go by 95%, and then we go by 99%, just like that. So we're gonna redefine this. So percentiles is so we're gonna create a for loop for this. So for I in percentiles, so we are creating a for loop to look up those values. So in this case, for I in percentiles is gonna be equal to, we gonna define our confidence interval. So our confidence interval in this case is gonna be equal to, we will say 100 minus I, because we already defined I, divided by 100. So in this case, the 10 there, as you see in percentiles, it's gonna be 90%, because if you take 100 and minus 10 and divided by the 100, it gives you 90%. So we are just defining our percentiles there. And then the next thing we want to do is to come up with the value. So the value in this case is gonna be numpy dot percentile, since it's a function and it's a formula, so we have to include the numpy, and then we go in bracket the returns of Apple AAPL, that's what we want, and then we want it to look for that among the percentiles, just like that. And then the next thing we want to do here is just to print this out. So we'll go print in plain English value at risk and then so we will print value at risk at, and then we want to define the percentage. So here we are actually formatting this in Python. So it's gonna be like this, and then we open the brackets like that, and then we hit a semicolon, 0.0%, like that. So that is the 90% or the 99% or the 95% interval. So we will write again confidence interval, and then the value in this case is gonna be, have a semicolon there. So having that set up, we can now print. So in this case, we're gonna be using some formatting. So in this case, we will go print in clear English, we open quote, and we go the value of risk at, and then column, we open the bracket, column dot 0, that is to signify the 95%, 90%, and the 99% interval. So we have to insert a percentage. So this in this case is gonna be the value at risk at 95, 99, or 90% interval. Confidence interval, we have to write that in plain English. Confidence interval, and then we have our column there. We open another bracket just like that, and then we have the column. We write a comma dot 0f, and then we have the quotes closed, and then we go dot format, and we want to include now our confidence and the value. And that's it. And if we've done it right, we can now hit enter, and it should give us the range of values. So we read shift enter, and as you can see, the value at risk at 90% confidence interval is roughly $16,000. The value at risk at 95% confidence interval is roughly $21,000, and the value at risk at 99% confidence interval is roughly $29,000. So what does this mean? So this is telling us that if you hold Apple stocks today for 1 month, the value at risk, there is a 10% chance the value at risk at 90% confidence interval is 16,651. So there is a 10% chance that you might lose $16,651. And the value at risk at 95% confidence interval is 21 to $67,000. So there is a 5% chance that you might lose $21,267. And the value at risk at 99% confidence interval is 29,823. So there is a 1% chance that you might lose $29,823 if you invest in Apple stocks today. Say you buy 1,000 shares at Apple, this is the risk you're exposed to. So this is very, very important, and it is very, very nice, and this is important for portfolio managers. This is important for individual investors. This is important for your strategies. You might want to change at a certain point, even your mandate, your investment mandate. So say that you want to go short a security, and then you can see the risks that is involved, and you might decide either to change the strategy or maybe to actually follow the strategy which you had before. So this is very important in investing, and this is really, really good. And you can use this to also take arbitrage opportunities in other markets. You can use this opportunity or this value at risk as an opportunity to diversify your portfolio. And you can also use this as an opportunity to go long short a stock. You can use this also to maybe embark on income bearing securities, or you might want to embark on capital gain securities, or you might want to embark on securities that allows for preservation of capital. So just you can see, this might expose you to many, many different strategies as you achieve your investment mandate. So why do we calculate the value at risk? This is actually the parametric approach to value at risk. It's very, very significant in modeling. So this is what we have done so far. And the next thing we want to do here is we want to calculate the next thing we want to do here is to calculate the mean, the standard deviation of the security. So we will go by the mean AAPR. AAPR is going to be equal to, we already have the returns in place, so it's going to be, in this case, it's going to be equal to, we can go by numpy, make sure it's lowercase, numpy.mean, and then we open parentheses, and then we go by the returns underscore AAPR So now we can calculate some important matrices. In this case, we're gonna already determine what the mean will be. Mean underscore AP here. We're gonna do the same thing for the standard deviation. Standard deviation underscore APR. And this time around is gonna be equal to numpy dot std, and then it returns APR just like that. And we can just round this to the nearest two decimal places, or we could still just round it to the nearest integer. But in this case, let's just round the mean. Round this to two decimal places. And we can do the same thing for the standard deviation. We could just round this to two decimal places. And then print mean APR standard deviation so as you can see, the mean is approximately $562 per share. So as you can see, that is exactly how much you're expecting. That is the average of this value at risk. So that's exactly what we are saying. The average returns of this stock. So exactly what we are trying to say here. And the next thing we want to do is to plot this in a histogram so we can very clear for you to see. So in this case, we want to plot a histogram. So we're gonna go plt.hist, and then we know that we have our returns underscore APR, and then we want to assign the beans to be equal to 100 in this case. And then the next thing we want to plot is we want to show some lines. So we're gonna go plt.axv line. So in this case, it's gonna be the first thing we wanna show off here is gonna be the mean. So we wanna show off the mean, and we want the color lowercase. We want the color to be, we want it to be orange, and then we want the line style to be dashed, and then we want the line width to be 2. So it's very obvious. And we're gonna do the same thing for the standard deviation. So we copy this, we copy, and then we can just paste it below, and then we can just edit for the standard deviation. So we go std, and then we can now also paste below for the value which we calculated. We had it simulated for us above as there is actually the returns of the security, but we have the loops looking into those returns. So we have the value already there, and now we can just go by PLT dot show. Then we run the code. We can now hit Shift Enter and see what happens to us. So as you can see, we have it set up there. We have the mean, and you can see the mean. We can see the standard deviation, and we can see the value at risk of investing in this security. So this is very clear for us to visualize this in a histogram. So having that said and done, the only thing we may want to account here for is gonna be the, let's just add a title to it. So we just go PLT, which is our matplotlib.pyplot, which we already defined from the very start of this coding. So PLT.title. So I want to assign a title to. So in this case, we will just value at risk. So we can now run the code. As you can see, we have that in place. The value at risk of investing in Apple stocks. So hopefully we can see clearly the mean, we can see clearly the standard deviation, and we can see clearly the value at risk of investing in the security. So like I said again, that it's very, very important for us to always determine the value at risk at every one point in time. We are investing in a basket of securities, or even in a single security, as this exposes us to many other kind of opportunities which we might want to take positions. Like we can want to take a short position on investing in a security like this. Say that we know that the stock price was going to fall by $16,000, and then we go short. That is, we borrow the stock from an investment dealer, and then we sell the stock, hoping that the price of the security was going to fall to roughly $16,000. So by the time we are selling the stock, at that time, 1 month from now, and then the price fell to roughly $16,000, and then if you can divide this by 1,000 shares, you will know how much this stock will cost after a month, or how much it will be per share basis. And you buy the stock and you hold it for 1 month, and you can see that you might want to buy back that stock which you sold because you went short a position. So you borrow the stock from an investment dealer, or you ask this investment dealer to sell the securities for you, and the investment dealer sold the security for you. Even though the security might be paying dividends, you'll be obliged to cover up for any dividend payments. But as much as you are very confident about your analysis, saying that the stock value was going to fall to roughly $16,000, then you might buy it back at this price when it fell to roughly $16,000, and you make a profit. So the difference between your initial short position, which you say you borrowed the stock for, and the price of the security after a month from now, when it fell to roughly $16,000, gives you a profit. So that's a profit on table. And the same thing, as you can see how much this security might fall to 21,000. You might see how much the security might fall to 29,000. So these are the various kind of risks you're exposed to. As such, you might want to take advantage, or you want to take opportunities in such a security, especially tech-based securities, because they are very, very volatile. That is why it's very, very important for you to calculate the value at risk and take opportunities, even arbitrage opportunities. You buy in one market and you sell in the other market and you make a profit. So that's exactly what we are saying here. So hopefully this gives you a drive on investing in certain securities such as this. So we have modeled everything up to this point. The only thing we may wanna include here is maybe we will just include the plt.axv line on this other chart. So in this case, we have the mean, which we calculated above, and then we had here, we will assign the color orange, and then we want the line style. So in this video, we want to demonstrate how we can predict the future price move of securities such as Apple. So Apple is a tech stock that trades on the Nasdaq with the ticker AAPL, and we want to know exactly what the stock is worth 250 days from now. That is 250 trading days from now. So that is why we are trying to look up the price of the stock, and we're going to be using Python to do this. So first of all, we're going to be running 10,000 different Monte Carlo simulations in order to predict the stock price move. And we will begin by covering the simple returns to log returns, and then we'll come back to convert back the log returns back to simple returns using the exponential function. The reason why we do this is because basically simple returns can't really be attributed by a normal distribution, and they are not additive. So as a result, we can use log returns because they are attributed they can be approximated by the normal distribution, and they are additive. So we're going to be using the log returns, and then we will later on convert the log returns back to simple returns. So the first thing we have to do here, we're going to have to assign our data frame, and then we will later on use the data frame to calculate the log returns. So the first thing we want to do here is we want to import some packages. So we're going to import numpy as np, import pandas as pd, import matplotlib.pyplot as plt, import yfinance as yf, and then from skypy dot start import num. This package contains all kinds of statistics and distribution functions we're going to be using in this model. Skypy.start, and then %matplotlib, we want to display each each chart below each code block. So we go %matplotlib inline, and then now we can run that code block, shift enter, and we're good to go. So the next thing we want to do here is we want to extract the data from Yahoo Finance. So in this case, we're going to go as far back as 2 decades ago. So we'll begin from the year 2000 up to the year 2024. So in order to do that, we will have to assign the ticker AAPR, that's the ticker which Apple trades with on the Nasdaq, and then the stock data, stock underscore data. We want to place this data in the data frame, so we're going to go by pandas dot data frame. We want to make sure the D and F is capitalized, as Python is very case sensitive. So we have that in place, and then the next thing we want to do is extract the data from Yahoo Finance. So what we're gonna do, we'll extract the data and we'll fit in this data frame. So we're gonna have to go by stock data, it's gonna be equal to, in order to download this data from Yahoo Finance, we're gonna go yahoofinance.download. We open parentheses, and then we assign the ticker, which is the stock we want to download from the Yahoo Finance, and then the start date is gonna be 2000. December 31st, 2000, and the end date is gonna be 2024. Put that 2024. Like that, and then the next thing we want to do here is to specify exactly the adjusted close, because that's exactly what we're looking for on Yahoo Finance. So we open bracket. So on Yahoo Finance, we have the adjusted close. That's exactly the column we want to extract. So we open brackets and adjusted close, just the way it is written in the column. Because Python is very case sensitive, so we write it in caps and the C in caps as well. So now we want to demonstrate this data in a plot. So in order to do that, we're gonna go by stock data, which we define dot plot, and then we're gonna establish the figure size to be equal to 10 by 6. So that's the length and the width, and then we establish our semicolon in order to run the code. Shift enter, and as you can see, we have the stock price of Apple from the year 2000 to the year 2024. So as you can see, we will first of all convert these returns, that is the returns of this price move. We will convert these returns, the simple returns, to log returns, and then we will later on convert it back to simple returns, because converted to log returns, it's gonna enable us to approximate this data using a normal distribution. And of course, it is additive, so it makes it very easy for us to go through calculating these log returns. So basically that's what we're going to be doing, and pretty much this is what is important for us to know. And we know that to calculate the returns is just the change in the prices of the stocks. So it could be the log changes, or it could be the simple changes. But in this case, as we said, we're going to be using the log changes of these price moves. That is the log returns. And that's what we're going to be doing next. So now we just want to demonstrate how this can be approximated by the normal distribution. So we're going to go by stock data. So we just want to demonstrate, in this case, a density plot. Stock data plot dot density. So we just want to demonstrate this plot. As you can see, the returns of this Apple stock could be approximated by a normal distribution. So the next thing we want to do, as I said, is we want to now convert the simple returns to log returns. So we're going to define our log returns to be equal to, in this case, since the numpy function helps us to calculate other functions in mathematics, so we use the numpy.log, and then 1 plus the simple returns. In this case, it's gonna be, we already have it in our stock data, in our data frame, which we constructed. So we go by 1 plus the stock data, and then dot percent change. We have it like that. And then open and close parentheses. So now, having done that, we can now just log returns, log underscore returns. As you can see, we have the log returns given to us from the year 2000 to this present date, that is the 10th of September. So we have the log returns of Apple stock. So what we want to do now is we're gonna print out the mean and the standard deviation of these log returns. So in order to do that, we'll go by mean equal to numpy.mean log returns underscore, and then the standard deviation is gonna be std numpy.std log returns. So we are just estimating the mean and the standard deviation. So in this case, we will just print mean and print the standard. So as you can see, we have the mean and the standard deviation there. So the next thing we want to do is just to demonstrate these log returns. So we just want to demonstrate these log returns. So in this case, we're going to go by PRT. We want to plot it. So we want to demonstrate it using a histogram. So we go PRT dot we want to plot it. So we go PRT.plot log returns to see how is distributed. So we PLT.plot and we plot the returns. As you can see, they can be approximated by the normal distribution. So you can see the log returns from 2000 to 2024. You can see we can use these to now do a lot of calculations. So the next thing we want to do is now we want to draw samples from a normal distribution, and we want to draw random samples from a normal distribution. So in this case, we will assign our simulations. Our Monte Carlo simulations will be equal to 10,000. So we're running 10,000 different simulations, and then we want to draw random numbers. So we're going to define as random numbers. So it's going to be equal to numpy.random.run in brackets simulations. So that's exactly what we're trying to do. And then the next thing we want to do is we want to draw samples from a normal distribution. So we already defined our random numbers. So it's going to be normal random numbers. So we redefined our samples in this case. So we would define it as normal random numbers. That's our sample. This time around, we're going to use the norm.ppf function. And then since we already defined our random numbers, it's going to be norm.ppf random numbers in parentheses random numbers. So we'll have to make sure that everything it is as we have defined. So in this case now, the next thing we want to do is to demonstrate this using histogram. So in order to do that, we gonna go by plt.hist and then random underscore numbers. Make sure we are referring to normal random numbers like that, and then we want to set the bins to be equal to 100. Like that. And then the next thing we want to do is to we want to set the bins to be 100. So having that done, we could just run the code, or we don't need to demonstrate. We know that it has a mean of 0 and a standard deviation of 1. But if we need to demonstrate that, then we will use the plt.axv line to demonstrate that. But like, we could still come do that later on in the model. So if we run this code, we can see that drawing samples random numbers from a normal distribution leads us to a mean of 0 and a standard deviation of 1. So in this case, we can now use these random samples to now predict the future price move of Apple stock. So in order now to predict the future price move, we will now have to define our trading day. So in this case is gonna be, we're gonna define our prediction, say intervals. In this case should be equal to 252 trading days, like that. And then the next thing we want to do here is we will just reassign our. So now we will just reassign our simulations to be equal to 10,000. And then the next thing we want to do is we want to calculate daily log returns. So in this case, we're going to be multiplying the standard deviation by our samples from this normal distribution. So in that case, we're going to include our standard deviation that we calculated using the log returns. And then we will use the standard deviation and we multiply it by our samples drawn from our normal distribution. So in this case, we're going to go by daily underscore log returns underscore simulated. It's going to be equal to std dot values. We multiply that by norm.ppf, which we already did above. So we are still again multiplying it by our random numbers drawn from a normal distribution. So it's going to be norm.ppf, and then in parentheses we open numpy.random.run, and then we open parentheses, and then we include our interval, that is 252 days from now. That is our prediction interval, and then the simulations. And that's that for that code. So now, having defined our daily log returns, now we want to convert that daily log returns back to simple returns. So in order to do that, like we said before, we using the log returns because it is additive and it can be attributed by the normal distribution. That's why we multiply the standard deviation of the log returns by our normal distribution samples. And then now we want to simulate our daily simple returns, so we have to convert that log returns back to simple returns using the exponential function. So it's going to be daily underscore simple returns underscore simulated. So we have to define it like that, and then in this case we will just have to convert the log returns back to simple returns. So in order to do that, it's going to be numpy dot exponential function, and then we will just include the daily underscore log returns like that, because we're just converting the log returns back to simple returns. So now, having that done, the next thing we might want to do now, we just daily underscore simple returns underscore simulated, just to demonstrate that. As you can see, we have the array of our daily simple returns calculated. So we have it right here. So having simulated our daily simple returns, the next thing we want to do now is we want to set up the last price. So we want to bring up what the last price will be. So in this case, we will use a function to bring up the last price, and bringing up the last price, we will have to assign our price list to be equal to 0, and just the last price will be featuring on that price list. So any other day on that price list, we will assign it to be 0, and the last price will be the only price featuring on that price list. So in order to do that, we will assign our last price. The last price, that is the 250th day price, is going to be equal to, in order to extract the last price, we're going to have to go like stock data underscore data dot ilog 0. So, and then having done that, well, what we're trying to do here is we are just trying to extract the last price. So ilog 0 logs and extracts that last price for us. So we can now last price just to determine what we've done, and as you can see, we have it set up for us there. So having done that, the next thing we want to do here is to set up our price list. So we go price underscore list. In this case, it's gonna be, we're gonna use the numpy dot zeros like function, and then daily underscore simple returns underscore simulated, and then price underscore list. We run the code. As you can see, we have set the price list to be 0 because we want this last price to appear on the top of the price list. So that's exactly what we're just trying to do here. But then we notice that here, to extract the last price, we have to go by -1 because we are locking the last price. That is, so we are going from 0, that is the very top of the first price, and then we are going -1 to the last price. So we have to log that as -1 to extract that last price. So it gives us approximately $220 per share as the last price. And then we have our price list set up there. And then the next thing we can just do here is to price underscore list. So we want to set up the price list at 0 to be equal to the last price. So that's what we're just trying to do here. So now we are setting now the top of the price list to be equal to the last price. So that's why we assigned, you can see the 0 in brackets there. So now, having that set, we can now just price underscore list to see what it gives us. As you can see, we have set the price list at the top to be equal to the last price. So having that set, we are now ready to determine our for loop. So in this case, we're gonna go for I in range. So we're gonna be using because it's the time, so we're gonna go for t in range. We want to set up the range to be from 1 to, remember our 252 trading day was defined as t intervals, so we're gonna go by for t in range, t intervals. So we now want to set up our t loop. So what we're just trying to say is that price underscore list at time t, it's gonna be equal to price underscore list at t minus 1, multiply that by our daily underscore simple returns underscore simulated at time t. So we are just looking for the time interval, the very top of the time interval. So that's exactly what we're doing. From I to t, we are looking for the price at the very top of the price list. So that's exactly what we're doing here. And then we are multiplying it by the daily simple returns at that interval, that is t, which we defined from 1 to t intervals, that is t. So having that said and done, now we already have our price list in place. The next thing we can do is to plot our price list. So we're going to go by PLT dot plot in bracket price list. And now we want to demonstrate the movement of this price, these prices into the future. So on the very top of the price list, we have our prices at $220 per share. We want 10,000 different prices on the last day, that is the last price, 10,000 different prices, as we determine using our Monte Carlo simulations. And we want to project that price into the future to see what it is. So like I said, we are projecting that price into the future. That's exactly what we're trying to do here. So if I go and I hit the semicolon, shift enter, and run the code, then we should see the distribution and the movement of that last price, which is at the top of our price list, into the future. As you can see, that last price moves into the future. 10,000 different prices move into the future. So that's exactly what we're saying here. So the next thing we want to do next is to calculate the drift due to economic conditions or changes in the equity cycle. So we want to account for any kind of drift that may arise as a result of price change. So we're going to take that into consideration as well. So in predicting the price move, we are still taking into consideration what might happen or the risk that might be involved due to inflation or maybe a change in the economic cycle or the equity cycle, or it could be the change in the economic conditions in the industry. So we want to assign for the drift. In order to do that, we're going to define the drift. So we're going to say drift, in this case, should be equal to, we're going to take half of the variance. It's going to be half of the variance. But in order to do that, we can't go by half of the standard deviation. So we're going to say the drift is half of the variance. But in order to compute the variance, we have to go back to make sure that we defined variance at the very start of our log calculations. Remember that we calculated the mean of the log, the standard deviation. So we could also as well calculate the variance of the log returns. So we make sure that that is in place. So in case that price move changes, so we will just simulate the variance. So the variance in this case is going to be numpy dot var in bracket log returns. So we make sure we have that in place. Then we can also just print the variance. So we auto redefine variance because the drift is going to be as a result of that variance. Or we could also use another matrix. It couldn't just be variance. We could also use the mean square error, or it could be any other matrix that we feel could be very significant in our model. So in this case, we will just use the drift is half of the variance. So that's what we are seeing here. And then we want to run the code again. We're going to run everything from scratch to see the drift from the future, and then we will later on demonstrate this price, this last price. We're going to demonstrate this at the last using confidence intervals or confidence levels to see the different ranges these prices in the future. I will also calculate the mean after the drift and the standard deviation after the drift to be very conclusive in our prediction. So the drift is going to be half of the variance, and then the daily log returns, we're going to redefine our t intervals to be equal to 252 trading days. And then we will also account for the simulations, which we want to run again. The simulations is 10,000. And then now we can now recalculate our daily log returns according to this drift. So we will go daily log returns equal to std dot values multiplied by our normal distribution num.ppf in parentheses numpy dot random dot run, and then so we are assigning now the simulations. To that calculation, we can close the parentheses again. And then the next thing we want to do is to now calculate the daily log returns with the drift. So in this case, we're going to go by daily log returns underscore simulated, and we will just add this drift to redefine that we are adding the drift this time around. So it's going to be equal to the daily log returns since we already calculated it above, and then we just add the drift plus drift dot values. So that's how we add the drift to the log returns. So in this case, it is half of the variance. So now we want to calculate the daily simple returns. So in this case, we will just go by daily underscore simple returns underscore simple returns. And then we will just assign this time around with drift. It's going to be equal to numpy dot exponential function. We will just use the exponential function to convert the log returns back to simple returns. So log returns, daily log returns underscore log returns with drift. So we have it set up there. So now we can just daily underscore simple returns with drift. We can now run the code. As you can see, we have it set up there with the drift included in our daily simple returns. So now we are now ready to determine the we are now ready to determine the last price. So in order to do that, we're gonna go by last price as we did before. The last price is gonna be equal to, we have the stop data, so we go underscore stop data, and then .ilog -1, we are extracting the last price. We can also just have it as well, just to demonstrate that, and then we go ahead again. This time around, we want to assign the top of the price list to be equal to the last price, and every other prices on the list should be 0. So in this case, we're going to go by numpy dot zeros like numpy dot zeros like daily underscore simple returns with drift. This time around, we're including the drift in values. So we have it set up there like that. And then we can now assign the price list, price underscore list, the top of the price list to be equal to the last price. So we want the top of the price list to be equal to the last price. So we can now price underscore list. We can print that out. And exactly what we expect. We have it at the top of our price list. So the next thing we want to do now is we want to define our for loop. So in this case, for t in range 1 to t intervals, from t in range 1 to t intervals, we want to set up the for loop. So the price list at time t, what is the price list at time t? In this case, it's going to be equal to the price list at t minus 1, which is the very top of the price list, and then we multiply that by our daily simple returns with drift at time t. So now we have our daily, we set up our daily simple returns with drift values at time t. We multiply it by the last price on the price list, t minus 1, and we have it set up there like that. And now we want to demonstrate this in a plot to see the drift of values in the plot, how these values are, or how these prices are projected into the future. So in order to do that, we're going to go by price underscore list. We can just dot plot like we did before. and then the price list. Hit a semicolon and we run the code to see the drift, the projections of these prices into the future, while assigning the drift, which is half of the variance. So it's 10,000 different simulations. So Python sometimes takes some time to run this code, demonstrating 10,000 different prices moving to the future. As you can see, we see that the returns, we can see clearly here. We can see clearly the movements of these prices into the future with the drift. So now we will be able to calculate, we will be able to calculate certain matrices based on this analysis of our drift in values of our prices into the future. So in order to calculate the confidence interval, that is the range at 90%, 95%, and 99%, to see the range of these prices to the future, we will have to use another for loop. So in this case, we're gonna say percentiles. We're gonna define our percentiles. Percentiles should be equal to, in this case, we'll assign it to be 10, 5, and then 1. And then we'll define our for loop for I in percentiles. For I in percentiles, and then we'll define our confidence interval. In this case, it's gonna be, open parentheses, 100, then we deduct I from it, and we divide by 100. So we can say 100 minus I, and I in this case is 10, 5, 1. So 100 minus 10, 90, divided by 100 gives us 90%. So that's what we're doing here. So we just have to make this 1. Make sure we are making it 1. Make it sure we're making it I, because it's a for loop. And then we'll assign the value, in this case here, to be equal to numpy dot percentile, numpy dot percentile function, and we will now have to assign the price list, price underscore list, but this time around we will go by, of course, -1, and then I. So that's what we are doing here, to find the range of values. So we are finding the range. We just want to know the confidence interval, 90% confidence interval. What would be the price, 95% confidence interval, and a 99% confidence interval. So now we can now print in plain English price can go by 250th the price move, like that, and then we open brackets again, and then this time we also have our column dot 0, and we assign a percent, and then you can now write in clear English confidence level. And we can just, so we go by the confidence level, and then we have a comma after that. And now we can also open another parenthesis just like that, and then column, comma, the dot 0f, that's the value. And then we close the quote, dot format, and then we can now assign our confidence and our value, and that's it. And if we have done this formatting right, we should see it run and give us this range of values. So if you go Shift Enter, you can see we have 252-day price move, 90% confidence level is $148. So we can also just add a $sign here so that it can be very clean for us. So we can just go insert a $sign and run the code again. So we have it there. So 250-day price move at 90% confidence interval is $148. Just add here. So we have it there. 252 price move at 90% of this interval is $148. So as you can see, we have this confidence level of 90, 95%, and 99% confidence interval of what the price will be in the future after this drift in values. Okay, so that's exactly what we're trying to do here. So after the drift in values, the price was worth $220 today. But after the drift in value, say 0.5, half of the variance, we calculated the price 1 year from now to be $148 at 90% confidence interval, and $129 at 95% confidence interval, and $101 at 99% confidence interval. This is after the drift in values. So let's go back and calculate this confidence level without the drift in values at the time here where we had no drift in values here. So let's calculate that here. We can calculate it here. So in order to do that, we will just have to we can just run it here. So we're gonna redefine our percentile. So in this case, it's gonna be percentiles equal to 10, 5, and 1. Okay. Since we don't want to mess up this section, so we can just go here just after this price list. So let's calculate that. So let's assign percentiles here in this case to be equal to, we will define it as so we will just redefine percentile here. So it's gonna be 10, 5, and 1. We can close the bracket. Then we want to set up for loop for I percentiles. Column, and then our confidence level, we go define our confidence level to be equal to, in parentheses, 100, and then we take out our for loop and then we divide it by 100, so that we are accounting for 90, 99%, and 95% confidence interval. And then we can now redefine our value, which in this case is going to be equal to numpy.percentile, in brackets, price list underscore list -1. Remember how we are arranging our data in this data frame. So price list -1, and then I, for we know that is the for loop. So if we are actually plotting these data on our AX line we are actually plotting a histogram, we could actually attribute this value to that histogram. So it's very clear for us there like that. And then the next thing we want to do here is we want to print in clear English, print, and we open two quotes, and then we go 250 a day, price move. In this case, we'll just rewrite everything of Apple stock at column, and then we continue with our formatting. We open our bracket, then we go column dot 0. We want that to be expressed as a percentage, so we go column dot 0%. We keep writing in clear English, confidence level, and we will just go by comma dollar instead of $, and then we can now open column dot comma dot 0 F. We have that in place, and then dot format, and now we can now insert our confidence and our value. So in this case, confidence and value, we have that in place, and now we can now print out this confidence level and see what it is for us prior to the drifting values. So we shift enter. It's gonna take some time because we have our price list already set up for us doing the plot. So sometimes Excel will take time to run everything together. So as you can see, we have it there set up for us. It is roughly 253rd day. You can see it there, 253rd day price of Apple stock at 90% confidence level is approximately $141 per share. So that's what we expect. And if we scroll to the bottom, we expect it to be 148 at the 90% confidence level after the drift. So you can see the difference. Here is 141, and at the bottom, after the drift, it's 148. And at 95% confidence level, it's at 123 before the drift. At 95% confidence level, 123 before the drift, and after the drift, it's 129. And as we can see, at 99% confidence level, it is $96. And after the drift, it is $101. So you see what happens to the securities as they drift in values. So the only thing we want to do here with this formatting is just to make sure that we have this confidence level well spelled out. So we can just assign it an arrow to it, and we have it well spelled out for us like that. So we can now just run the code again. So hopefully this gives you an understanding on how to simulate the price moves of a particular security before the drift and after the drift. So as you can see, we have calculated the price move of Apple using the Monte Carlo simulations, 10,000 different simulations running the last price. And we have done everything to this point where before the drift, the confidence level at 90% was $141, and the confidence level at 90% after the drift was $148. So we did this, and also you can see for the 95% confidence level, $123. And if we scroll to the bottom, we see that at 95% confidence level, it's $129. So hopefully this gives you an understanding on how to simulate price moves of a particular security like Apple stock. So this could help you in a lot of trading strategies going forward. So hopefully this is a guide on how to simulate price move of securities like this, which is very, very important because, Apple is a tech company, and we know the risks of investing in technologically based stocks. Their returns are very volatile. So that is why it's very important for you to sometimes simulate the price moves of certain securities into the future. So now what we want to do is we want to plot this in a histogram. So what we're going to do now is we're going to now plot this using a histogram. So we're going to define, in this case, we go by mean underscore AAPL. We want to redefine the mean to be equal to numpy dot mean, and then price underscore list like that, and then bracket -1. So we want to calculate the mean, and let us now just round this up to 2 decimal places. So we can go around, open another bracket, and we go to the end, 2 decimal places, close the parentheses, and now we can also calculate the standard deviation. So it's going to be SDD underscore AAPL, and then we will do the same thing. numpy dot std. Then the price list, we want to calculate the standard deviation, of course. Then we go back and we just round it to 2 decimal places, close parentheses. And then what we want to do next is we want to demonstrate the plt dot hist. In this case, price underscore list -1, and we want to set the bins to be equal to 100. And then the next thing we want to demonstrate in this is going to be plt.axvline. And this time around we want the value, and we want the color to be equal to, we go by orange, and we want the line width first of all define the line style. You want the line style to be dashed, and the line width, you want the line width to be equal to 2, so it's obvious. So we can set it up like that. And then the next thing we want to do is we want to plt.title, the print of the title for this. So plt.title, it's gonna be Apple future price move to 150 TFD future price move. We want to print that in one model. And so what next is that we want to print the main of the price move, main APL. Also we want to print the standard deviation, Now, having that set and done, then the next thing we just want to do is to run the code. So in order to do that, we'll go by plt.show open parentheses. Then can now run the code. As you can see, this is our distribution. So we have it set up there like that. So we have the value there, and now I can just copy all of this code, copy all of this, copy, and we paste it. Just paste it here, Control V, and let's just try to edit Yeah, we just paste it down and then we just edit is to be equal to, let's identify the mean of this we can run the code again just to identify the mean. Also, we can also do that for the standard deviation. So we can also just paste that again here. Standard deviation. So in this case, it's gonna be std underscore ABL. We run the code again. So we have everything set up there. As you can see, we can re-demonstrate this. As you can see, we have the mean of $235 per share. But let us just we can see the mean of $235 per share and the standard deviation of 59.2. So that's exactly our estimate of this price after the drift. So that's exactly what we are seeing here. So we have the mean of roughly $235 per share and a standard deviation of 59. So if you're buying the stock, this is gonna be what you're looking at. The mean, the average is gonna be sold at 235 days, $235 per share on the 250th day. So 252 days from now, we are estimating that the stock price will be approximately $235. That is the mean approximation of what the price will be. But if we are looking at the confidence interval and the confidence level, we can see that the 95% confidence level says it's 129, as you can see. And also we have it as 101 here for the 99% confidence level. So this is the value of there's the price at 99% confidence level at $101 per share. So we can do the same thing we can copy all of this and do the same thing for the price before the drift. Copy. So before the drift, we can estimate the mean and the standard deviation and also plot a histogram for that to see what the price after the drift, before the drift looks like, the distribution, the mean as well, and we can also see the standard deviation. So in this case, so now we can do the same before the drift. So before the drift and values, we could just copy everything and then we paste it over here. So we want to paste that. It's gonna be, you can just paste it here, whatever we have simulated to be the mean of this price list at this point in time, and the standard deviation at this point in time, and we want to demonstrate this using a histogram, and we want to also just calculate the mean and the standard deviation to see how it differs from the drift and values of this price move. So that's what we're trying to do here. So we can just run this code again. So we go Shift Enter, and we just wait for a while because we have a lot of things. Python has a lot of things to recalculate there for us. So just patiently wait to see what's going to happen there. So as we will expect, this is exactly what we're expecting to see. But we have the prices mixing up with our histogram, which that's not exactly what we want, but we can see that the mean is still approximately 235.34. It's approximately the same mean we expect after the drift, but you can see that our confidence level gives us a quite different approach or different values to the values after the drift. So that is exactly what we are trying to demonstrate in this model. But in this case, we could just cut this to leave our model just the way it was before. And just make sure that we're having everything as before. So we can just cut this and leave our model as before, and we run the code like that. So that is before the drift, and we have our confidence interval and at different levels which we have simulated. If we just want to add this, maybe we could just add it here. We could add it here to just that's let's just add it here. It's going to give us what we want. So as you can see, just exactly as we said. So the mean doesn't make any difference to the time when the drift happened. So you can't really estimate the price move by taking the average, that is the mean, that is the $235 per share. It's approximately, if you go down, it's approximately the same thing here, $235.34 per share. But when you take into account the confidence interval, you can see the difference prior to the drift and when the drift happened. So as you can see, prior to the drift, we had this confidence level at 90% at $141, and after the drift, it was at $148. So as you can see, there is a significant difference when we take into account the drift in values. So last thing again, this could always be, we could always have this in place because we want to account for certain movements or certain changes within the industry or the economic cycle, or we want to account for certain discrepancies in our model. Like in this case, we took into account the variance